Okay, today we will talk about option pricing a little bit more. If you remember last week, Tuesday, we talked about very basics of options, and I just wanted to introduce you to the terminology about options. So this week we're gonna do more hardcore problems, and we're gonna move to Black-Scholes formulation for options, which is still used in academia and in the industry. So in the option pricing, I will start with binomial option pricing. And then we're going to talk about where we have more than two time periods. So we're going to move to a more realistic calculation of option pricing. So if you get lost anywhere, stop me and ask me a question. Tuesday, we went very slowly. We went over things very slowly. This week, you might get confused over things. Whenever you have a question, let me know, okay? Okay, so we covered this part, sorry. Let's go to, yes, here. So what am I going to do today is, I'm going to start with this example, which is similar to what we did before. But then what my aim is to have a formula and to have an easy way of dealing with the problems. So if you remember last time we did some replicating portfolio exercises, but this week I'm going to show you where things come from. So let's start with this example. It says, suppose a stock, it is worth $25 today, and in one period will either be worth 15% more or 15% less. And in 1 year, if there's 15% increase or decrease, the price will either be $28.75 or $21.25. So it is 15% increase or decrease from $25. The risk-free rate is 5%. What is the value of an at-the-money call option? So that's the question. So what am I going to do? So today, we start with $25 worth of stock. And next period, the stock price can either be $28.75 or $21.25. So in this case, what is my payoff, basically? If the stock price becomes $28.75, today's price is 25, so my payoff will be the difference between these two numbers, right? Since the stock price increased, I have positive payoff. It is worth $3.75. Or when we have a decline in stock price, my payoff will be 0. I'm losing money. So it's a bad thing. So what am I going to do is I will try to replicate the same thing with call options, basically. So what am I going to do is I'm going to borrow some money from the bank, and suppose that I'm going to borrow the present value of $21.25. Don't ask me how I come up with this number. I will show you where this comes from later. And I'm going to borrow that money, and I'm going to buy 1 share of stock. So the net payoff in this case will be what? So the same thing. The stock price becomes $28.75 or $21.25. Since I borrowed some money from the bank, after 1 period, I need to pay off my debt. And the value of the debt next period is $21.25. So next period, I'm paying off my debt. So my portfolio worth will be $750, or it's going to be 0. So when you have a call option with $25 strike price, what happens is these are the payoffs of the call option. This is the payoff of my portfolio. So can you see the relationship between these two? So this is basically twice as this, right? So what I can see here is when I borrow money, buy 1 share of stock, it gives me payoff, which is twice as much as having a call option. So what can I do here is, let's move here. What I can do here is I can find the call premium, the price of the call from this relationship. Do you remember what we talked about before? We said if there are two portfolios with the same outcome, they need to have the same price. So I have this call option which will give me half of what my portfolio can give. So here, this is what 1/2 comes from. Its value will be worth having the stock and borrowing money from the bank. And the present value of the borrowed money will be 21.25 over 1 plus the risk-free rate. Here we're assuming that we can borrow money at the risk-free rate, and I'm going to tell you why it's the case later. So from this relationship, I can calculate the value of the call option. And this is what's going to happen. The value of the call will be 238. So what we're doing is if you buy 2 calls, its payoff will be equal to buying stock today and borrowing present value of 21.25 today. So from this relationship, we found the price of the call option. Any questions here? Does it make sense? Yes.
What's spot price? 21.25?
Strike price is 25.
What about spot price today? 21.25?
No, what are you?
Like, how can you buy a stock from $21?
Oh, no. You're buying the stock for $25. It's the price of the stock.
Okay, it's spot price.
Yes, stock price is 25. I'm borrowing money which is equivalent to the present value of 21.25. So I'm borrowing 20.24 actually from the bank at the risk-free rate. This is not a made-up number. You're going to see where it comes from later. So if you do that, this portfolio will give you the same payoff of 2 call options, basically. So from this relationship, you can calculate the price of the call option. Anything else? Yes?
Can you repeat the 1 over 2 parts?
Okay, it is because when you buy 1 stock and borrow 2024, that portfolio will bring you twice as much as 1 call option. So you can either put this 2 here. So if you buy 2 calls, then those 2 calls value will be equal to buying the stock and borrowing 2024 from the bank. Anything else? Nothing? Did you get it or did you get lost? Okay. Even if you couldn't understand 100%, just keep in mind what we're trying to do. We are trying to replicate a portfolio. So instead of buying a call option, what else can you do? I can buy the stock. I can borrow money. As I said, where this number comes from, I will show you. There's a very easy formula, but just understand the intuition behind why we're doing this. Okay, so we found the price of the call. So as I said before, what we are trying to do is we're trying to replicate portfolios, and from those we are trying to find the pricing of the call options or put options. Okay, so now you're gonna ask me where do these numbers come from? And it comes from a basic formulation, basically. So delta is something new. Delta will give us how much stock you need to purchase. So delta will be determined by how much the call payoff changes compared to how much stock price changes. So in our example, if you remember, our stock price is either 28.75 or 21.25, and call payoffs are either 3.75 or 0, right? So using this, I'm going to find the delta. So basically, delta will be 3.75 minus 0. This is the swing of the call option, of the payoff. And this is swing of the stock. So it is going to give us 1 over 2. So this is basically telling us how much stock we need to buy. It says buy half a stock. Then let's move to, let me write it down. Maybe we will need it later. Delta is swing of the stock, call, over swing of the stock. Okay, so this tells us how much stock we need to buy. Then what am I going to do? I'm interested in finding the amount I need to borrow, right? First, I'm going to show you the long way, and then I'm going to show you the short way later. So we already found the call premium, which was 238, and this was equal to the stock price times delta, so how much stock you bought, times the stock price, minus amount borrowed. So what it means is you're paying, what, 12.5 to buy the stock, but you need to borrow money from the bank so that we can replicate the portfolio. So from here, if the call premium is 238, then the amount you need to borrow is 10.12. So what it says is borrow 10.12 from the bank, buy half a stock, its value will be equal to the call option. Is it consistent with what I showed you in the previous slides? In the previous slide, I said buy 2 calls, and I said it is equivalent to buying 1 stock and borrowing 2024. Do you see it here? It's the same thing. So I'm just dividing everything by 2. Buying 1 call is equivalent to buying half a stock and borrowing 10.12 from the bank. Okay. But where does this number come from? So the borrowed money will be given by actually this formula. So it's going to be delta times the stock price when the stock is up, minus the call payoff when you're in the up state, over 1 plus the risk-free rate, which is equivalent to so from this equation, we can also find the amount you need to borrow so that you can replicate the portfolio of buying 1 call. So in this example, if you do I have it here? No. In this example, let's do it together. Delta, we already calculated. It was 1 over 2. Stock price in the up market was what? 28.75. Minus the call payoff was 3.75 over 1 plus the risk-free rate. What was the risk-free rate? Do you remember? 105. So this should give you the amount of money you need to borrow. Okay, so from this equation, you can easily find B, amount of money you need to borrow. You know how much stock you need to purchase from delta. So buying delta amount of stock and borrowing B amount of money from the bank will give you the call price, because you will be able to replicate the portfolio. Now, questions?
What is SD and C?
Okay, so this is, let's go back here. So this is the up state, this is the down state. Up branch, down branch, okay, as long as you're consistent, I don't care what you do not. So here in the up case, SU is 27.75, stock price in the upper branch, and CU, call payoff at the upper branch, is 3.75. Here in the down branch, SD is 21.25, CD is equal to 0. So it's basically stock price and call payoff at the upper branch and down branch. Anything else? If you're lost, please ask me, please. Because this is like an easy example. We're going to do more complicated stuff. Okay, so this is what the binomial world is all about. I don't know whether you noticed, but we didn't do anything. We didn't make any assumptions about the probability of having an up state or down state, right? Did I tell you what is the probability of having the stock price equal to 28.75? No, I didn't say anything. It's because in this world, we're assuming we're in a risk-neutral world, which means the expected return of any investment is equal to the risk-free rate. And with this assumption, with this simple assumption, we are basically able to calculate the call or put prices very easily. And this is not a very unrealistic assumption. But as I said, we're talking about two-state world, which is way far away from the real world. And with Black-Scholes formulation, we will go into the real world. But I want to show you whether we're going to obtain the same results using another approach, which is risk-neutral approach. So let's start with this. So in this case, again, we have an up and down state, okay? The probability of having an up state is Q. The probability of having a down state is 1 minus Q. So the probabilities should be equal to, the total probability should be equal to 1. So at this point, the stock price is SO, the call price is CO. After one period, the stock price will either be SU or SD. The call payoff will be either CU or CD. Okay? And from here, if you're interested in how you're going to calculate the call price, it is from the simple formula. And I know you deal with trees and stuff in other classes, so you're probably familiar with it. It's basically expected value of something. So with Q probability, you're gonna have CU. With 1 minus Q probability, you're gonna have CD. But these happen in the second period, one period later. So I'm gonna discount those values by the discount rate in the economy, which is the risk-free rate. So it is expectations about the payoffs. Okay. We can also write this as this. I can also do the same thing for, I can also do the same thing for S, stock price, which is basically the same thing. With Q probability, you're going to have SU. With 1 minus Q probability, you're going to have SD. These happen in the first period. So I'm discounting them with 1 plus risk-free rate again. Okay, from here, I can actually show you the, okay, so this is basically just the same thing. I'm just moving the location of things a little bit. It's the same thing. From here, I can find the probabilities. I can find Q and 1 minus Q. Q is having an up state. 1 minus Q is having a down state. So let's look at the same example. So the stock is worth $25 today. In one period, it will either be $28.75 or $21.25, if I remember correctly. Risk-free rate is 5%. What is the value of the call option? We already calculated it, and we found it to be 238. But let's see whether we're going to find the same thing using the risk-neutral approach. And surprise, surprise, they're going to be the same, of course. But I need to show it to you. Okay, so we already know how the tree will look like. So the price will be $28.75 or $21.25. These are the probabilities. And we can move to the next one. In the next step, I'm interested in calculating the probability. This is coming from the previous slide. Remember I said, oh, we just played with the formula a little bit and we have this formula. So just plug numbers in the formula, that's it. And from here, I find that the probability of having an up state will be 2 over 3. So the probability of having down state will be equal to 1 over 3. From here, I can calculate the call option price. Again, with the same formula. Oops, sorry. Okay, so this, we also know, we talked about this before. In the up state, if the strike price is 25, the call value will be 375, the difference between 25 and 28.75, or the call payoff will be equal to 0. We also know that. So from here, I know the probabilities, I know CU, I know CD. From here, I can calculate C using this formula. So from this formula, again, find all the, plug all the numbers in. The call premium will be equal to 238. This is actually remarkable. Why?
I didn't get what.
Sure.
$0.
Oh, if the strike is 25, you're not going to exercise the call, so your payoff will be 0. Thank you. There are a couple of people who missed last class, so thanks. Let me just remind you that call option gives you the right to buy a stock at a predetermined price. And this predetermined price is called exercise price or strike price. So you are going to exercise the call option only when the stock price is higher than the exercise price. So in this example, for instance, the exercise price is 25. If the stock price becomes 28.75, this option will give you the right to buy the stock at 25, and then you can sell it in the market for 28.75. So you're making 3.75. If the stock price becomes 21.25 in the market, the exercise price is 25. So it doesn't make sense for you to exercise the call option, because if you exercise the call option, you have to buy that stock at $25. Doesn't make sense. Buy it in the market for 21.25. So that's why payoff should be equal to 0. Thank you. I should have done that at the beginning of the class. Okay, so this is important. Why? I just show you you can use binomial approach without knowing the probability of having an upstate or downstate. So with any probability, in the first way of solving things, we didn't make any assumptions, yet we got the same result assuming risk-neutral approach. Why it's the case? Because change in the stock price now actually kind of cancels out all the expectations about the future prices. So that's why without assigning any probabilities, we were able to find the call premium in the previous example. Okay, any questions on those two things? So we talk about replicating portfolio approach. This is important. From here, I didn't write the formula for C, but if I remember correctly, C was equal to this. Let's just keep those on the board in case we need them later. Okay, so we talk about the intuition behind those formulas. We talk about the risk-neutral approach. And now we can slowly move to the Black-Scholes formulation. By the way, I don't know whether you saw it. You have a homework due next Thursday. The questions are very simple. It's not like the second homework I assigned. It's a simple one. I'm going to give a more difficult one the week after. Okay? It's just like a little exercise for you. Okay. Okay, so in the binomial approach, we assume that we are in a world of two states. Is it realistic? It's not realistic. So what we will try to do is we will move to multivariate models, and we're going to see how things will change a little bit. Then we're going to move to Black-Scholes. Okay, let's start with this example. Suppose that we have two periods now instead of one. Okay, you have a call with strike price of 50 and risk-free rate is 6%. So let's write this down. So we have a call, strike price is 50, risk-free rate is 6%. So now what am I going to do is I'm going to start working from the last periods, and I'm going to move to today so that I will be able to find the price of the call. So we start with $40, the price of the stock. After one period, the stock price can be 50 or 30. In the second period, the stock price can be 60 or 40 if we start with the upstate. In the downstate, the price can be 40 or 20. So question, if we are here, would you exercise the call option? Would you exercise the call option if the price is 60? The exercise price is 50? Yes. How about the call payoff? It's going to be equal to 10. Here, would you exercise the call option? No. Here, would you exercise the call option? No. Perfect. Okay, so let's focus on the up markets. So the price can either be 60 or 40. You already told me about the call payoffs. From here, let's calculate delta, B, and C. And, okay, let's see. For delta, I need the difference between CU and CD, and I need the difference between SU and SD. So you tell me, in this example, what is CU? C, payoff of the call when you're in the up branch? Huh? 10. What is CD? Okay, can you all see this? Any questions about where those numbers come from? No? Okay. So we're just focusing on those two. We are already in the upper branch. So what is SU? 60. What is SD? Okay. So what is delta? 1 over 2. Perfect. Okay. Now I need to calculate beta. Sorry, not beta. Borrowed amount. So we have 1 over 2 times SU is 60 and CU is 10. And you can do both way. You can also use SD and CD. It's going to give you the same thing. And the risk-free rate is 1.06. From here, I think the amount borrowed should be 18 something. 1887 maybe. I'm not sure. 20 over 106. Is this correct? Okay. So for C, I'm using this formula, delta times the stock price, 50, minus the amount borrowed. So C should be equal to 6.13. Okay? So now we have something like this. Okay? So if you're in the up state, then the call value will be 613. If we are in the down branch, let's go back to our original picture. If we are here, you're not exercising the call. You're not exercising the call. So the value of the call is 0. I don't need to do any of those things because call is worthless anyway. So I know that if I'm here, the call value is 613. If I'm here, call value is 0. So this is what we have. Okay? So the value of the option is either 613 or 0. Now I reduce this multi-period to, it was 2 periods before. Now I reduce it to 1 period. So now what am I going to do? I'm going to do the same thing again. And this part is a little bit easier, let's say, because there's only 1 period. So what am I going to do now? I'm going to ask again whether I'm going to... okay, so sorry. Let me just move on. Sorry. Yes. Okay, see, this is where I am. So from here, what am I going to do? I know SU. I know SD. I know CU. I know CD. So I'm going to use the same formulas to find the call premium today. So what do I have? In the up state, my call payoff is 613. In the down case, it is 0. The stock is worth 50 in the up state, 30 in the down state. So the swing, delta will be equal to 0.30. Then from here, you can find the borrowed rates using the same formula. Borrowed rate will be 867. And then you can calculate the call option value from here, which will be equal to 359. So when I give you multi-periods, what are you going to do? You're going to start with the last periods. You're going to use the formulations I just showed you. You're going to find CU and CD. After that, you're going to have only 1 period. You're going to do the same exercise. Find the price of the call today. Any questions on this? Yes, thank you.
Is the 40 the spot price today or the exercise price?
Today it is the stock price.
Okay,
Exercise price is 50 for this call. exercise price is not changing, right? You're buying the call today, exercise price is fixed. The call will expire at time 2. Exercise price is always 50. Stock price is changing. But we needed to deal with multi-period thing because we didn't know how to solve multi-periods before. So what you're going to do is start with the last periods and go to the first periods, then find the price of the call today. Anything else? Let's look at the intuition behind that. So basically what we are doing is we are talking about the dynamic trading strategy. So every period you need to reconsider your trading activity. And in this example, let's try to go over this. I'm going to go over this very slowly, but I think it's interesting since it is putting the real intuition of the numbers on words, let's say. So what happened is we started with a strategy where we bought 30% of a stock, which was the last thing we did, if you remember, right? So this is the last today's delta, okay? How much shares you need to get, and this is how much you need to borrow right now, okay? So you start with buying 30% of a stock, and then you borrowed 867. After one period, there can be two things. The price can go down to 30, or it can go up to 50, I think. So let's focus on the case where stock drops to 30. In this case, your shares will be worth how much? It's going to be worth of how much shares you have times the price of the stock. The price of the stock became 30. You have 30% of a share. So the value of the stock became 920 after one period. And your debt grew by the risk-free rate. So you borrowed 867 from the bank, grew it with risk-free rate 6%. So now your debt value became 920. As you can see, your portfolio is worthless. Your stock's value is 920. You have to pay off your debt to the bank, 920. So that's what happens if the price drops to 30. What happens if the price increases to 50? So this time what happened is you kind of replicated your portfolio, and this time we already calculated your delta should be equal to 1 over 2. So you started with 30% of share, but replicating portfolio tells you need to have 50% of a share. So you bought additional shares. And for those additional shares, you have 19% more additional shares. And when the stock price became 50, so the value of the additional shares became 967. So what you need to do, you need to borrow more money. You don't have that much money. So you started with 867 in time 0. The value of the debt grew by the risk-free rate to 920. But since you need additional financing to buy extra shares, you have to borrow 967 more. So the total value of the debt became 1887, which is also what we found. So what happened is the value of the stock now, since you have half a share, the stock price is 50, the value of the stock became 25, and 1887 is how much money you need to return to the bank. So the difference is 613 is the value of the portfolio, which also what we calculated. So do you understand that we started from the second period and moved to 0 first? Now those last two slides tells you what really happens when you start from today, go to period 1, go to period 2. This is really what happens in real life, basically. Any questions? Is this silence all about understanding everything, getting bored, or having no clue whatsoever? I cannot do anything about the being bored part, and first is also good. You got everything, perfect. If you have any questions, ask me. Okay, let's look at this example. Please read the question. Suppose the current price of Narver Network System stock is $50 per share. So stock price is 50. In each of the next 2 years, the stock price will either increase by 20% or decrease by 10%. The 3% one-year risk-free rate of interest will remain constant. Calculate the price of a 2-year European put option on Narver Network System stock with a strike price of $60. So what are we going to do? First, you need to form the tree. So you start with $50. It's a 2 periods case. $50 stock will either be 60 or it's going to be 40. And then you need to extend it to another period. And it's already here. So after 1 period, the stock price will either be 60 or 45. By the way, you need to know how to draw trees. In the real options, we're going to use those kind of trees a lot. Okay? So you need to be familiar with it. So in the first period, stock price becomes 60 or 45. Then you're growing it by 20% or you're decreasing it by 20%. So in the second year, the stock price becomes 72 or 54 or 10.5. So again, what you do is you start from the last period, period 2. So this is a put option. Put option gives you the right to sell the stock at the exercise price. So if the stock price is, did I say it correctly? Put option gives you the right to sell the stock at the exercise price, okay? So if the stock price is 72 and the strike price is 60, would you exercise your put option? No, you can sell the stock in the market for 72 instead of 60 exercise price, so it's a no. And would you exercise the put option when the price is 54? Yes, because you can sell the stock for 60 if you use the put option. So your payoff will be 6. And if the stock price becomes 40.5, again, you would exercise the put option and the put value will be equal to 19.5. So after this, what you do is you start with calculating the deltas and borrowed rates. The idea is same, put option or call option, everything we do is the same. And then from here, you move to time 0. Should I go over the example or should I leave it for you? Because, I mean, there's the answer here. It's the same thing. Okay, so go over this example at home. And if you have any questions, let me know, which is, I mean, it's almost the same example with what we just did. And you're already kind of bored. So I'm gonna continue. Okay, so we look at binomial models where we had 2 cases in each period, right? So we had this increase in stock price, decrease in stock price, that's it. But in real world, of course, the stock prices change infinite number of times. So this time we're gonna move to a more realistic model. What is this? This is basically how a randomly generated stock price path will look like. So basically what is done is we assume that every period we are increasing the stock price by 1% or we are decreasing the stock price by 1%. And we are doing this for almost 1,000 times. And when you do that, stock price path will look like this, which is very similar to how in real world stock prices move. So when you increase the number of periods and number of probabilities of having different stock prices, you're going to approach the real world more. So what we're going to do in this case is we're going to use Black and Scholes model. So what we have here is the call price or put price. This formula will be different a little bit. Call price will be calculated like this. So what we have is we have the stock price here. We have the normal distribution of D1, and I'm going to show you what D1 is. Actually, let me show you. Okay. So D1 will be calculated like this. You have the stock price, you have the exercise price, you have the risk-free rate, you have the volatility, and you have T, time to expiration. So those will give you what D1 is. Then on the other part, we have the exercise price, e to the power r times t, which is continuously compounding rate, actually. And here we have a normal distribution for D2, and D2 will be calculated like this: D1 minus volatility times square root of t. So let me write the formula here in case we need it. So T0 will be equal to S and D1 minus X e to the power R times T, and D2, and D1 will be equal to ln S over X plus R. And D2 will be, okay. So from here, we can calculate the option prices. And this is what we're using still in real world. I have a paper. I'm using this also. So in academia, this is what we use. Okay. So a little reminder, what is this N function? N is the cumulative standard normal probability function. In the exam, I will give you the tables, normal tables. So you can find the numbers. So if I have N minus 1 is equal to 15.9%, it tells us there's a 16% probability of having an observation from the standard, a 16% chance that an observation from the standard normal distribution will fall at this range, less than minus 1. So this area, this value will give us N minus 1 basically. Okay, and let's try to link this to what we saw before. So basically this is very similar to what we did before. It was the delta part. So if you look at this, so we have delta times stock price minus beta. So this is the stock price. This was kind of the delta now. It is basically the expected present value of receiving a stock at the expiration. And you will only receive that stock if the stock price is higher than the strike price. So when you exercise the call option, this is how much you're going to pay for the stock. And this part is kind of like the B we saw in the binomial world. This is present value of paying the strike price at expiration when you exercise the call option. So together, it's going to give you the value of the call option. For put option, the formula changes a little bit. It becomes like this. I'm not going to go over it. It's just formulation. And then we can solve questions. So let me check the time. Okay, let's look at this one example. Find the value of a 6-month call option on Hardcraft Inc. with an exercise price of $150. So what am I going to do? I'm going to use the formula. I need a couple of things. One is the current value of the the stock price, which is $160. Risk-free rate is 5%. The maturity is 6 months. It says 6-month call option anyway. And the volatility of the asset of the stock is 30%. How do you calculate volatility of a stock? You look at the standard deviation of the prices, right? So volatility is about riskiness of a stock. The more volatile the stock, the riskier it is. Okay, so it is 30%. It's given. With this information we have at hand, we already know that the intrinsic value of this option should be equal to 10. Why? Exercise price is 150, stock price is 160. The difference between these two will give you the intrinsic value. The value can be higher than that. You already know. If the value is higher than 10, it means there is time premium, and you're gonna send me emails, or some of you already did, why time premium might be positive. So you're gonna answer that. But I know that the minimum this call option should be is 10. At least you can check your answers like that. So what am I gonna do? I'm gonna calculate D1 and D2. Stock price is 160. Exercise price is 150. Risk-free rate was given, which was 5%. Risk-free rate is 5%. And T will be equal to 1/2. Why? Because it's a 6-month option. So T is in terms of years. You have half a year, so this should be equal to 0.5. So if you put plug all the numbers in, D1 will be equal to 0.53. And D2 will be equal to D1 minus the volatility times square root of T. So it's going to be equal to 0.31. Then you need to find those values from standard normal distribution tables, but I will give those to you right now. So this is ND1 and ND2. After that point, you basically know everything. Stock price is 160. You know ND1. This is the exercise price. This is the risk-free rate. This is time. Oops, sorry, just opposite. Risk-free rate, time, and then you have ND2. So from here, you can find the call option, which is equal to 2092. Any questions? Okay. Everything is very clear, right? Oh, it's so easy. Okay, try to do the homeworks, then we're going to talk. Okay, so before take the break, let's go over another example. We're going to do the same thing with different numbers. Please, at home, try to find those numbers, try to find those answers. Now I'm just explaining everything to you, and I'm going over the answers, and everything seems very easy, but I mean, you know the fiasco in the first midterm. Okay, let's not have the same thing in the second midterm. Okay. I'm going to put practice questions on options this weekend with the answers. So you're going to have lots of practice questions as well. Don't worry. Okay, consider a stock that is currently selling for $35. You're looking at a call option that has an exercise price of 30 and expires in 6 months. This risk-free rate is 4%, compounded continuously. The volatility of stock returns is 25%. What is the call price? You're going to do the same thing. You're going to find D1 from the formula. Stock price is 35, exercise price is 30. Just be careful about T. It's a 6 months, so T should be equal to 1/2. That's the only thing. So after finding D1 and D2, the second step is finding the values from the table. I'm going to put an example table on Moodle, so you can use that one as well. So from here, you can calculate the call premium, which is equal to 6.08. Another thing is I'm actually going to put this Excel document on Moodle, so it will give you the value for call and put. How do I zoom in? Zoom. Then I thought this is what I did in the first case, but okay. So let's try to do this for our example. So we have standard deviation, which is volatility, maturity, risk-free rate, stock price, and exercise price. Let's find it. Stock price was 35. Exercise price was 30. What is the risk-free? Do you remember? 4%. Okay, maturity is 0.5, and standard deviation is 0.25. So from here, the call value will be around 608, which is, I think, very close to what we found, right? What did we find? Do you remember? 608, yes. So I'm going to put that as well, so you can check your answers. And I put down how everything was calculated here. So there are the formulas for each cell as well. So you can play with it. Okay, do you have any questions? Let's take a 10-minute break, and then we're going to continue.